Good afternoon, or I guess good morning to all of you. Thank you so much for joining us today. My name is Steve Jewell. I'm with Community Giving. We're going to give people a few minutes to gather into the virtual space here, and we know we have a few groups that are out there also watching as a group. So we'll give people just a minute or two just to gather, and then we're going to get started with our webinar for today. Okay, well, it is 11 o'clock, and so I think we're going to get started. Once again, thank you so much for joining us today and spending part of your time with us. Again, I'm Steve Jewell with Community Giving, and we're delighted to have you join us for a very important topic. Community foundations work with professional advisors and donors and the overall community. And one thing we all are concerned about is our local economies and our regional and national economies. And as of late, with things that have been happening across the world, we've seen markets go up, we've seen markets go down, and we know that there's been quite a bit of market volatility and a lot of concerns about its impact on our communities and how it impacts our investments, especially those dollars that eventually will go out to support our local communities. And so today, we're very fortunate to have a couple of experts with us to talk about understanding the current market volatility and what's happening in our economy. A couple of just housekeeping items is that we will be having a time for questions and answers, but please feel free to put your Q&A or your questions in the chat and in the Q&A tab. We will get to them as we go through the presentation today. Also, we will be having another webinar series for professional advisors in particular, talking about some topics over the course of the next year as we go into fall and winter. But we welcome your ideas. If you have some ideas of topics you think it would be good for us to cover, please put them in the chat, and we greatly appreciate you sharing your ideas with us. So to get us started, I'd like to introduce Elise Weiner. Elise is the Director of Finance and Investments for Community Giving and works with all of our donors, fund holders, and foundations. And so I'm going to turn it over to Elise to introduce our speakers for today. Elise.
Thank you. Thank you all for joining us. We're very excited to hear insights into the current economy and investments in particular, because everybody's talking about it right now. First up, we want to introduce Joe Mahon, who is the 9th District Regional Outreach Director of the Federal Reserve Bank of Minneapolis. He has also served as a regional economist and analyst for the region's Minneapolis Fed publications. Joe tracks several sectors in the 9th District, including ag, manufacturing, energy, and mining. Joe, we'll hand the screen control over to you.
All right, great. Let me just get my slides up on the screen, if you'll bear with me for a moment. And it looks like I've got them up. Let me know if you are having any issues seeing them. So thank you for the invitation today. I'm going to be speaking about the economy. Not surprisingly, I don't know that I'll have much intelligible. Well, certainly I know that I won't have anything intelligible to say about investing. But what I hope to do is give you a little bit of a sense of both where our economy is, both at a national and regional level. And in particular, I'm going to talk about the inflation picture and how that's affecting Federal Reserve policy. And I think that should probably be a pretty good way of teeing up the latter portion of our presentation. And again, just kind of hope to provide some context for all of those of you out there who are kind of thinking about how these things affect your decisions. One quick thing, a bit of housekeeping before I go any further, is just to give my standard disclaimer that our lawyers like us to give, just that I'm my views are my own and not necessarily those of the Federal Reserve. And this usually covers me for any kind of foolish thing I might spout off on. But the one thing that I do kind of want to lay out at the outset is I have to be very careful not to give any kind of a forecast or prediction about interest rates and future monetary policy, and you wouldn't really want to take my forecast anyway. So I do know that is probably primarily what folks are going to be interested in. What's the interest rate outlook and what's going to happen with Fed policy? And what I hope to do, rather than give you a prediction of what's going to happen, which I don't think would be a very useful thing anyway, is to give you a better kind of broader sense of the context and how we as policymakers are thinking about the economy and reading the data that come in, and how that's kind of going to have influence the stance of policy. So I hope to that it'll be pretty interesting and useful to you. I'm going to start with a little bit of background on the Federal Reserve itself, just kind of get sort of level set that I'm clear about kind of what we do and what our function is, why there's a Fed, and some other things of that nature before I get into the national economic update. I am, as Elise mentioned in the intro, I am a regional economist, so I primarily spend my time focusing on our part of the country. But right now, people are most interested in the national story, and so that's what I'm going to be focusing on. And again, in particular, with respect to inflation. So I'm also going to talk about kind of the labor market and overall economy, and in particular, I'm going to talk about inflation and how that's influencing the recent changes in Federal Reserve policy with regard to interest rates. And then, if I have some time, I'll probably share a little bit of results we have from a recent survey on business conditions in our region. I'll talk a little bit more about what I mean by our region in just a moment. So that's kind of where I'm going, really kind of unpacking the inflation and monetary policy story as it's developed over the last few years. Quick few words just to get started, though, about the Fed and what we do. So the Federal Reserve is America's central bank. A lot of people don't really know that we're not actually a federal agency. We were created by Congress, by act of Congress, the Federal Reserve Act in the early 20th century. What makes us federal is that when they created the Federal Reserve System, sort of observing this long tradition in American history of distrusting concentrations of power, especially economic power, they divided the country up into 12 different Federal Reserve districts, and that's what makes us federal. So just like the United States has 50 states and a federal government, the Federal Reserve is a federal system with 12 reserve banks. You can see the map of the reserve banks here. They kind of reflect where the population lived in 1914 when the system was designed. So heavy concentration on the East Coast. And you can see that in the 9th Federal Reserve District, we cover the states of Minnesota, North Dakota, South Dakota, Montana, and then we have portions of Wisconsin and Michigan, the Upper Peninsula of Michigan, northwest portion of Wisconsin. And that's our territory that we cover at the Minneapolis Fed. It's a large region, geographically fairly diverse, diversified economy, and that's sort of what my job is, along with some colleagues on my team. I mentioned this decentralized system that the Fed has, and the fact that this was designed really, again, kind of for historical, political reasons, but it does have one other benefit, which is that in dividing up the country in this fashion, it requires us, in making national economic policy, to pay close attention to what's happening in different regions of the country. So monetary policy, the decisions that the Federal Reserve makes with regard to interest rates, they affect the whole economy. You don't necessarily want to be making policy just based on what's happening in one part of the country or the other. So so that's what my job is, along with some of my colleagues, is keeping our leadership, our policymakers briefed on what's happening in the Federal Reserve's 9th District. So again, that we all kind of have a voice at the table when we're making this policy. So the Fed has a number of different functions. We were created originally to serve as a lender of last resort, to provide liquidity to banks in times of financial crisis. We did that during the financial crisis of 2007 through 2009. We're also a bank regulator because we have the authority to give emergency loans to banks. We want to make sure that they don't end up through sort of negligent behavior, sort of getting into that situation in the first place. So we do have some regulatory authority over banks. We're also the fiscal agent of the U.S. Treasury. That means we're the U.S. government's bank. When you pay your taxes, it ends up in an account in the Federal Reserve Bank. The U.S. Treasury has an account here. And then we also provide payment services. We operate electronic payments infrastructure. We operate a check clearing infrastructure as well. But the thing that we're best known for is monetary policy, which is conventionally talked about in the press as raising or lowering interest rates. But really what it is the influence of the supply of money and credit in the economy that we influence through open market operations. I can explain what that means in more detail if you're interested. And we make monetary policy with two goals. So the other main, just to mention, the other main instrument of national macroeconomic policy, of course, is fiscal policy. That's setting of taxes and spending by the federal government. We don't really have anything to do with that. Our influence is on monetary policy. As I mentioned earlier, the structure of the Fed, there's these 12 reserve banks. Each of those banks has a president and a board of directors. We have a president in Minneapolis, his name Neel Kashkari. We have a board of directors. And each of these presidents of each of these reserve banks travels to Washington 8 times a year to meet with the Board of Governors. That's the governing body that oversees the Federal Reserve System. The Board of Governors has a chair. Currently, that's Jerome Powell, or Jay, as we call him affectionately. Prior to Chair Powell, it was Janet Yellen, and prior to her, Ben Bernanke, and some of you might remember Alan Greenspan as well. They often talk about that person as the chair of the Fed, but the Fed is, again, as I mentioned, a decentralized structure, and there's other governors on the Board of Governors. 8 times a year, they get together in Washington, and they spend a couple of days poring over economic data, including this regional data that I was talking about, and they end up setting the target for our interest rate, the overnight rate of lending between banks. That's the federal funds rate, which influences other interest rates. And they do that with 2 goals in mind. By act of Congress, we're required to make monetary policy with what we refer to as a dual mandate. And you can see that the letter of the law sort of right there. But our dual mandate is full employment. We want to make sure everybody who wants to get a job can find a job, and price stability. So low, stable, predictable rate of inflation. We want our money to keep its value relatively over long periods of time. So those are the 2 goals of monetary policy. And we spend a lot of time looking at data on those 2 things to see how we're doing relative to that and to determine what the stance of policy should be. One challenge with the data is that all of the data that we have on labor markets, on the economy, on inflation, the best data that we have, which come from various U.S. government agencies like the Bureau of Labor Statistics, are all backward looking. So they tell us what's been happening. The policy that we make today has its effects in the future. And so you need to kind of project where you see the economy evolving in order to make appropriate policy. And that's why a lot of the work that I do with my colleagues is really more qualitative. We do a lot of survey work. We spend a lot of time talking to businesses and getting their insights because they have a better sense of where things are heading or evolving than the data that we have, which are backward looking. So that's just a kind of a bit of a context for what we do at the Fed and what I spend a lot of my time looking at, thinking about. Before I get into the actual meat of the issue, which is where are we with regard to this dual mandate? As I mentioned, maximum employment, price stability. We had the big story of the last few years, of course, is the pandemic and its effects on the economy. Right now, it wouldn't be a surprise to anybody listening to know that we are really experiencing historically high levels of inflation, rates of inflation that we haven't seen in several decades. I'll show you some data on that in a moment. But you have to start before getting into what's going on with inflation right now. You can't ignore the effect that the pandemic had on the economy. And if you look at a lot of different economic data series from the last few years, and they look a lot like this. Fairly stable prior to February of 2020. A lot of them are the inverse of this. You see the data fall off a cliff. This is the unemployment rate. So it's the Bureau of Labor Statistics attempt to measure how many people are out of work but looking for work. That is to say, they're not retired or somehow other out of the labor force, just currently unemployed but involuntarily. And you can see that this shot up in early 2020 as all those businesses went into lockdown and were furloughing employees. And by historical standards, it's come down pretty quickly. I'll show you some more data series on this in a moment. And right now in Minnesota, we're actually below where we were prior to the pandemic. Our unemployment rate was on slightly upward, but still historically very low prior to the pandemic. We're actually down below 2% official rate of unemployment in Minnesota. Now, there's reasons that the unemployment rate doesn't tell you the whole picture. I can get into those if you're interested. The U.S. unemployment rate still slightly above its pre-pandemic level as of July, but just about where we were prior to the pandemic. This is what all the data series look like. So I was just showing you the unemployment rate. That's kind of an attempt to measure labor force slack. This is non-farm employment, or total, what we call payroll employment sometimes. This is just a measure of the total number of people working, and I've got it in millions here. And you can see that it peaked in February 2020, and it fell by 22 million people who were working in February 2020, who weren't working in April of 2020. And again, by historical standards, this was a remarkably quick recovery. Typically in recessions, you see, first of all, you never see employment fall this far. What happened in 2020 was unprecedented and somewhat artificial, different than a normal recession because it happened so quickly and was so, the magnitude was so much higher. And the recovery has been pretty cool, but we did just get in July back to our pre-pandemic level of employment. So even though we know from talking to business people around the region and around the country about how tight labor markets are and how hard it is to find employees, for the last more than 2 years, we were still below our total aggregate level of employment, and that's not even taking into account population growth. That's just the total number of people who were working prior to the pandemic. So if you get back to about a year ago. And I'll start talking about inflation in a moment, but there's been a lot of discussion about why didn't the Fed act sooner in response to rising rates of inflation. Well, a year ago, we were still several million people below where we were in in terms of pre-pandemic employment. Now, nobody knows there's not a correct level of employment. But we did know that there were still a few million people, fewer people working than there were in February 2020. If you put now, and as I'm showing you here, you can see we're back to our pre-pandemic level of employment now. Just got slightly above that level in July. I anticipate that we'll probably see another increase in August when those numbers come out in a couple of weeks. In terms of the ratio of the population who are working, though, we're still below. So this is the employment to population ratio. It's just basically the number of people working, the number I was just showing you, relative to the total number of sort of employable people, if you were, people that are of working age and that aren't incarcerated or somehow other out of the labor force. You can see we're still about 1.2% percentage points below where that ratio was prior to the pandemic. So by this measure, there's still some room for the labor market to recover. Again, if you talk to businesses, and this is, if I have time to get into some of our business survey results, we know what one of the biggest issues that our businesses in our region are facing is how tight labor markets are, and we're seeing that reflected in high rates of wage growth. A lot more I could say about that, but that's just to kind of give you a sense of where we are. A year ago, that we were still, I think, it was pretty safe to say that we were still some ways away from maximum employment. Now we're back to pre-pandemic levels of employment, and in some cases where the labor market is even stronger. Certainly, if you look at wage growth. So what about the inflation picture? This is a long-term representation of inflation. I'm not going to dwell on this. Sometimes I like to present the kind of longer-term data. So all of the data that I'll be showing you on inflation come from the Consumer Price Index. This is a data series that's published by the Bureau of Labor Statistics. The idea was originally to sort of give a sense of what the cost of living is, so that employee, so that employers and unions could sort of, work that into negotiating compensation. And what you can see, so the CPI is just kind of an overall measure of kind of the cost of living. You can use that to calculate employment. You can use that to calculate the inflation rate. Basically, what they do is they have actually there are several hundred economists who work all over the country for the Bureau of Labor Statistics. They literally go into grocery stores, hair salons, other places of businesses, and record prices of goods and services. They take a large sample every month for over 150,000 different goods and services. They average those out, and they try and summarize it into one number, which is basically just a weighted average. And what they do is they also do surveys of households and how families spend their money, and they they take every good that's in the index, say a stick of butter or a loaf of bread, and they weight those by how much. In the broad categories, how much a typical family spends of its budget on those items. So how much of your budget do you spend on food versus clothing versus your cost of housing? And so all those things get a weight in the index, and it's an attempt to kind of, again, summarize what does it cost to live. And you can see what this is ultimately, though. People tend to think of inflation as rising prices, but ultimately what inflation is actually, it really is fundamentally is a decline in the value of our currency. We tend not to think of it in those terms, but really what money is just a good that can be universally traded for other goods. We price everything else in terms of money, so the value of money is what you can buy with money. So you measure the value of money by looking at the prices of things and how they change over time. And you can see over the long period, over the last 100 years or so, we've had kind of on a year-over-year basis, a lower rate of change on a year-over-year basis in inflation than we had prior to the U.S. Operating on a commodity money standard. Our money isn't backed by gold or any other physical commodity. It's what we call fiat money, and that's the value of our money is managed by the Federal Reserve, our central bank, just as it is in all the other industrial economies around the world. And the sort of trade-off here is that over long periods, when you have commodity money standards, and I should stress here that the earlier values going back to 1800 are estimates cobbled together from historical numbers. It's only the current consumer price index goes back to about 1913. Over the long run, under sort of a gold standard or other commodity money standard, money tends to maintain its value over long periods of time, but it fluctuates a lot more in short periods of time and rises and it falls. And so you can see this just kind of gives you a sense for the longer term historical picture of inflation. Nobody really cares about that other than academics and nerdy economists like me. What's more relevant to us is what is our own cost of living, and you can see that reflected here. This is basically the same data I was just showing you, except on a monthly basis, and I'm showing you the the year-over-year change in the consumer price index. So basically the annual rate of inflation, and I'm showing it to you in two measures, what we sometimes call headline and core. So that light blue or aqua colored series is the overall rate of inflation, what we call the headline rate of inflation. That gold bar is what's sometimes referred to as core inflation. That's the same number, just stripping out food and energy prices. Why do we strip out food and energy prices? It's not because they don't matter. They're a large part of most people's budgets, but they tend to be a little bit more volatile. So they move around a lot on a month-to-month basis, as we've been seeing and all experiencing with gas prices recently. So you just get two different measures of inflation. You get kind of a cleaner signal of the sort of future movement of inflation. You might have seen the July inflation numbers came out earlier this month. There was a little bit of reporting on how on a month-over-month basis, there was actually no change in inflation. There was a 0% change in inflation, but that was just from June to July. And a lot of that movement was due to just downward movement in gasoline prices. Gasoline has a pretty heavy effect on the overall rate of inflation. I tend not to focus as much on the annual or on the monthly movements in inflation. Those can be informative, but I think most of us really are thinking more about this in terms of a longer terms. So that's why I've plotted it here in the 12% or in the 12-month terms. And what you can see is that, yeah, in July, the annualized rate of inflation came down slightly, but it's still right now, prices are still about 8.5% higher than they were in July of 2021. So the overall rate, it came down, it ticked down just slightly, but it's still, historically speaking, very high and unacceptably high by the Federal Reserve standards. I should have mentioned earlier, the Federal Reserve has a medium run target of 2% for the rate of inflation. And this is for the overall rate of inflation. We don't just target this core measure. Like I said, sometimes the core is an informative thing to look at to give you an idea of where inflation is heading. But what we ultimately care about is what the cost of living is. A little bit of detail.
Hey, Joe.
Yes.
Oh, sorry. We just have a question, if you don't mind, kind of on
Absolutely.
that last slide. Okay,
Yeah.
great. I'll read it to you quick. What are the underlying reasons driving our current inflation rate? A year ago, the Fed. Oh, sorry.
Oh, no, go ahead.
A year
Please.
ago, the Fed called it transitionary. What changed?
Yeah, so that's actually the rest of what I'm going to be talking about.
Oh, okay, perfect. Sorry. Keep going.
So no, I mean, this is a good question. This is ultimately the meat of what we're really focused on right now. So what are the things underlying the change? There's this term transitory that some policy wonks and some people in the Federal Reserve were throwing around a year ago. That was this idea that the blip of in inflation that we were seeing, the upward tick in inflation that we were seeing in late 2021. And just to go back here, you can see that here. We started to see, I mentioned this 2% target. We've had that 2% target for more than a decade. That is to say, that's our official target for the rate of inflation. We've tended to run by the Fed's preferred measure, which is slightly different than what I'm showing you here, slightly below that target. And then you can see in kind of mid 2021, we started to see inflation accelerate. There were earlier indications, by the way, that we were seeing increasing inflation. If you look at wholesale prices, a lot of the information that I was getting from manufacturers about input costs started to take off much sooner than this. This question about what this issue of transitory and was it the right call to say that inflation at that time was the idea was, well, this is a temporary blip that we might be seeing due to these supply chain issues and some of the pandemic recovery. I'm going to make the case that in retrospect that was a wrong view, but at the time, given the data that were available, that story was making sense, and it kind of explains why the Federal Reserve was a little bit slow to change policy. Again, you start to see inflation accelerate into late 2021, but the inflation that we were seeing, and I'll break this down for you in a minute, was really confined to a few sectors that were really heavily affected either by the pandemic and the recovery from the pandemic, or by the supply chain crisis that we've been experiencing. So there was this sort of hopeful view that those things were going to kind of work their way out and we were going to kind of return to normal and we'd start to see inflation return to normal. But what we saw instead was that the inflation we were experiencing became more widespread. So much more to say about that, and I'll get into that right now, but just a few other things to show you about kind of the most recent data on inflation. So where's the movement coming from? Well, gasoline is the big one. Now, gasoline in July actually on a month-over-month basis contributed negatively to inflation because gas prices have come down over the past 6 to 8 weeks from their really high peak earlier in the summer. But on a year-over-year basis, they're still much, much higher. So more than 40% higher in July than they were a year earlier. And then overall energy prices, which include gasoline, but also other prices. Airline fares, that's another one of these kind of pandemic and also energy-related stories. Airline fares up quite a bit. These aren't necessarily representative of where people spend their money. Gasoline, obviously, an important part of household budgets and not something that you have a lot of discretion over. You can't necessarily just stop buying less gas because it's more expensive. You typically have to buy less of other things when it becomes more expensive. And that gets into kind of the effects that shocks energy prices have on the economy. But you can see here a few other categories. Food, obviously, another major contributor to inflation, obviously another important part of most people's household budgets, unless you're very wealthy. And then used cars and trucks is an interesting one, because if I were to show you this chart from a year ago, that would be the leading category. And that's really a supply chain story. That was this this issue that, you know, it's taking longer to get new cars because of the inavailability of semiconductors. Huge inventories of new cars waiting to be delivered because they're waiting for chips to go in them. And so people have been substituting by buying used cars. Vehicles are a large part of household expenditures, so they had a lot of weight on the way we measure inflation. That was a big part of the story. So again, just to kind of tee up this issue of, you know, why were some people saying inflation was maybe the inflation we were experiencing in late 2021 was transitory. It seems it's because it's a lot of the movement in inflation was confined to a few things like used cars and trucks, and then services that were recovering from the pandemic. So getting into this services and the pandemic story, this is another major part of the inflation picture that we're seeing right now. So here, so this is a measure of personal consumption expenditures. So what are households spending their money on? What are in broad categories? And what you can see here is that, like all the other economic data series, it dropped precipitously in early 2020. However, spending on goods recovered very quickly, and in fact is much higher than it was prior to the pandemic. So if I were to show you this data series going back a much longer period of time, you don't see the kind of growth that we've seen in that aqua colored line. That's durable goods. Those are big ticket household items like appliances, vehicles, construction materials, electronics. The kind of growth that we saw in getting into late 2020 and early 2021 was really historically unprecedented. And partly this is a sort of this is a structural or a substitution story. So if you think about that early part of the pandemic, getting into the shutdown period in 2020, Americans spend a lot of their money on services, on things like going to the salon, on things like travel, food away from home, eating at restaurants. A lot of the ways that we normally spend our money weren't available to us early in the pandemic because of the shutdowns. And so people just started substituting. And once it became clear that the economy wasn't necessarily falling off of a cliff, people had a lot of money sitting around because they weren't spending money the way that they were used to, and they started buying a lot of goods. And you can see that reflected in the growth in goods purchases here. And I have it broken out by durable and non-durable. Non-durable are things that last less than a year, typical household consumer items like toothpaste. It's really the durable goods that are the big story here. We're fully about 38% higher spending on durable goods now than we were in early 2020. And again, that kind of growth in that period of time is pretty unprecedented. And this is actually at the root of a lot of that supply chain story. So you get into the picture about a year ago, so about after the economy starts opening back up, things start returning to normal, and you start to see some of these supply chain effects in things like vehicles. And you start to see an increase in the price of goods relative to services. And that's what I have here. This is the ratio of the price index for durable goods relative to services. And again, services, broad category, people spend a lot of their money on services. Over time, you tend to see the price of goods fall relative to services because of technology. It gets cheaper to produce goods. You need people to deliver services. People don't get cheaper over time. So if I were to show you this same data over a long period of time, this ratio of goods to services prices, the long-term story would be a decline. And what you see starting in mid-2020, as people are buying a lot more stuff and not buying as many services, is you start to see the price of goods increase relative to services. And this is kind of an unusual pattern, historically speaking. And that's part of the reason for the belief early in this current inflation that we're experiencing that this was maybe a temporary phenomenon, because over the long term, goods prices actually tend to go down relative to the prices of other things. So I'm going to kind of walk you through the blow by blow, and I'm really glad you asked that question because this is kind of tees up where we are now where we were a year ago. So now I'm showing you a slightly different picture here. I've been showing you mostly things in year-over-year terms. This is the month. So this is basically the monthly data that come in, and what are the contributions to the inflation rate that we're seeing on a month-over-month basis. And this is just to the core. This is excluding food and energy. And I've lumped a number of things together into this category of pandemic-affected services. So that would be things like lodging, travel, restaurants, things that were heavily affected by the pandemic. And then I've got just vehicle-related expenses that are broken out in this gold bar. Remember that story I was telling about the supply chain and vehicles and how that was a really big contributor to inflation. So if you look at when we started to see inflation accelerate in the second quarter of 2021, a lot of the movement that we were seeing, as you can see there, was due to vehicle-related expenses. Again, people tend not to buy cars a lot, but when they do, it's a large part of your budget. Your car payment is typically a large part of your budget. So that was really pushing up the rate of inflation a lot. The fact that new cars were getting more expensive and used cars were getting more expensive because of the sort of substitution effect for used cars. And we started to see a recovery, of course, in some of the most heavily pandemic affected services like travel. The economy started to open back up. People are starting to feel comfortable going to restaurants again. And so we started to see some contributions to inflation that were really concentrated in areas that were heavily affected by the pandemic. Now that's through the middle of last year. You get into the summer of last year and you start to see some easing in the monthly increase in vehicle prices. The level is still high. It's just that what's happening on a month-over-month basis had kind of cooled off. And then you start to see actually some retreat as that Delta wave, if you can remember that, of the pandemic takes off. And this story still looking pretty good going into the fall of 2021. Also, by the way, I haven't really mentioned this yet, but I just basically everything else here is lumped under other in this category. So you can see on a month-over-month basis, everything that's not falling under the category of vehicles or pandemic affected isn't contributing a lot to the overall rate of inflation on a month-over-month basis. But then you get into the later part of the year. And not only do we start to see more pressure on these vehicle prices, and again, bigger increases in these pandemic affected services, but the big important story is we start to see inflation get more widespread. So this other part of the bar here starts to get larger, and so this story that well, maybe this is just a supply chain and a pandemic recovery effect that's going on, a rebound effect. Starts to look less convincing once you get into late 2021 and especially into the beginning of this year, and that's when the Fed started. That's when the Fed officially changed stance of policy in March of this year. Was the first interest rate increase by the Federal Open Market Committee. Just to kind of get back to the sort of year-over-year picture, and again, I was just showing you excluding food and energy prices here. This is just to kind of give you an idea of what the contribution of food and energy has been on a year-over-year basis. And you can see goods are in here as well, and services. So on a monthly basis, the annual rate of inflation that we're seeing, what you can see from here is that we've started to see more pressure in the cost of services than we were seeing earlier in this bout of inflation. Still a lot of pressure coming from goods. And that's really, I've gone back to a longer period in time for a reason. Because I want you to see that typically we don't see this kind of increase in the prices of goods that we've been seeing since mid 2021. This is pretty unprecedented. And I should say a little bit of cause for optimism as well, because we know that a lot of this is due to the supply chain, the supply chain disruptions that we've been experiencing. And then, of course, a huge part of the inflation that we're seeing right now is in food and energy, and you can see those. This is just going through June, by the way. If I were to show you, the latest month, you'd see a little bit less contribution from energy. Again, on a year-over-year basis, the energy costs are still really high, and this is a year-over-year basis. On a month-over-month basis, in July, energy was a net negative contributor to inflation. It brought down the overall rate of inflation. So if you look at that core rate of inflation, that was still positive in July. And that kind of underlies why it's useful to look at that sometimes, because oil prices, food prices are so volatile relative to other prices. So that's kind of the inflation picture that we're coping with right now. Inflation, it's not just that the rate of inflation that we're measuring is high, it's that it's really widespread. It's a broad-based phenomenon. It's not just concentrated in a few areas. And it's been accelerating until recently, until this last month, where we started to see some easing in inflation. But that's just 1 month of data. And I wouldn't be doing my job as a statistician if I didn't tell you that you don't ever want to read too much into 1 month of data, because there's always errors and there's always statistical noise in the data. So that kind of gets into the background of why the Federal Reserve has been tightening policy so aggressively since March of this year. So they raised interest rates for the first time in March. And then, of course, for the last 2 Federal Open Market Committee meetings, they raised rates by 75 basis points. Again, the rate that we target is that overnight rate of lending between banks, but it affects other interest rates as well. And you can see that reflected in, for example, mortgage rates, which have just ticked back up to about 5.5% on a 30-year mortgage right now, and a number of other rates as well, treasury rates, prime credit rate, and a suite of other interest rates as well. And that's all because the Federal Reserve is tightening in order to get the inflation that we're seeing under control right now. So there are a lot of factors that are causing inflation that are not necessarily monetary factors. It's not necessarily that they're not necessarily due to the fact that there's too much money chasing too few goods. There are these supply chain issues. There's the energy issues. A lot of them, of course, are due to geopolitics that are beyond our control. But the Federal Reserve is taking a pretty strong response because we need to get inflation back to an acceptable level, and right now it's unacceptably high. And that's why the sort of aggressively tightening stance of monetary policy right now. And they've made it pretty clear that just getting a 1 month of relief in the rate of inflation isn't good enough. We need to see a sustained decline in inflation to a more acceptable level. So that's what they've been kind of trying to broadcast. When the Federal Open Market Committee meets, they release a statement kind of basically explaining what their decision was and what the thinking was behind it. And they've tried to be pretty clear about that. Jay Powell is speaking tomorrow at the Kansas City Fed does an annual conference in Jackson Hole, Wyoming. It's kind of the big to-do for monetary policymakers around the world, and Jay Powell is going to be giving a speech there, and a lot of people paying attention to that. But they've been pretty clear already about what their thinking is and what their plan is going forward. So that's kind of what I have to say about the sort of the inflation and monetary policy picture. I have a few more minutes, so I'm just going to kind of close things out with there's a lot of concerns now. Of course, the other consequence of tightening monetary policy is it's by design meant to cool off the economy. It's a tool. A lot of the inflation that we're seeing is due to supply factors. Monetary policy works through demand. So by raising interest rates, it's more expensive to buy a house, to buy a car, or at least to borrow to do those things. And that's going to bring down demand, right? So there's a concern that by tightening monetary policy, it's going to be recessionary. So we do a lot of business surveys, as I mentioned, because businesses have good information that's not necessarily reflected in the data yet. And I'm just going to kind of walk through a few of the headline results from a recent survey that we conducted with businesses in our region. You can find all this information and more on our website, minneapolisfed.org. So I'm just going to walk through it really briefly. Bottom line is there's some indications that economic activity is slowing among businesses in our region. Demand for labor is still really, really strong. So the labor market is really tight. That's why it's a little confusing right now. I think some of the talk about recession is a little premature just because the unemployment rate is still low. We're still seeing month-over-month growth in employment at a national level of really strong. Over 500,000 new jobs are created in July, for example, nationwide. And wage growth is really strong. Of course, inflation's eating into that. So the real growth in wages is lower than we'd want it to be. So that's the kind of headline picture in terms of revenues. Businesses, across a number of different time frames, as you can see here, and I'm not going to kind of get into the details of the chart. Again, but across a number of different time periods, businesses are telling us overwhelmingly that their revenues are flat or slow. That's again comparing to the most recent quarter relative to the period or relative to a year earlier. Their expectations for the future quarter relatively flat. Now, this I should point out, this is coming off of a period. If you were to look at our recent surveys of really strong growth. And so this is coming off of a pretty strong pretty strong period of growth, and you can kind of see that reflected over time. So I'm just kind of breaking this down by revenue. We ask businesses, did your revenues increase or decrease, and by how much? And you can kind of see where that category is. We have a smaller percentage of businesses telling us that their revenues declined a lot, but we also are seeing a smaller percentage of businesses telling us their revenues are increasing a lot. So this is kind of movement toward the middle, kind of toward flat sales over the past year. I should mention my colleague Ron Wirtz did and I'm not going to spend a lot of time on this survey, but my colleague Ron Wirtz did a webinar on these results with a lot more detail that you can find on our website. Just kind of consistent with a lot of what we've seen throughout the pandemic, larger businesses are doing better than smaller businesses in terms of the revenue picture. In terms of the challenges that businesses are facing, so we kind of give them a broad suite of things to identify as their primary challenges. It still remains labor availability, the input costs or inflation, and the supply chain issues are really still the overwhelming issues that they're facing. And this is just, I'm kind of showing you the percentage of people who identified this as their biggest challenge relative to the beginning of the year. It's really labor and supply chain is really the kind of biggest businesses. Now, in terms of the labor market, like I said, there's a lot of talk about recession right now. Overwhelming majority of firms we speak to are still looking to add headcount. Close to 40% are hoping to add full-time employees. 70% are increasing in some capacity. And we actually have a decreasing share of firms telling us that they're not looking to increase headcount. So just going by the labor market side, still pretty strong economic conditions in our region, at least. And with that, I think I'm gonna skip over some of the rest of these results. I'm just gonna get into the outlook here, and just mention that we are seeing, again, if you look at what the sort of optimism pessimism index that we are asking businesses about for the near future, we are seeing overall kind of decline in sentiment, but still net positive. The majority of businesses still telling us that they're somewhat optimistic or neutral or very optimistic for the near future, although there's a growing share expressing pessimism. And that's, again, not surprising given what we know is going on with regard to the overall economy. But on balance, still positive sentiment among businesses in our region, at least. A lot more to be said about that, but I'm going to kind of I'm going to cut it off there so we still have plenty of time for questions. I hope this was interesting, and if there's anything that I said that seemed that didn't make sense, or if you'd like to challenge anything I said, you think I was wrong about something, happy to hear what you have to say about that.
Thank you, Joe. We have two quick questions before we move on, but the first one, how much did the excess increase in government spending contribute to inflation?
So that's a really broad question. It's a question I get a lot. I don't want to sound like I'm kind of waffling on this. It's just really hard to say. We won't really have a good answer to that, like what I consider a good answer as an economist. We won't really have a good answer to that for several years. Now, intuitively, it would make sense that, okay, we had this big injection of spending financed by deficits into the economy during the pandemic and after the pandemic, and that would have the effect of increasing demand. You end up with this consequence of more money chasing an equivalent or a smaller amount of goods and services. And so all else equal, that should have an inflationary effect. The problem is, this isn't something that happened in an all else equal world. It happened in a world where we had a massive global pandemic that caused a huge negative shock to the economy. It caused 22 million people to be, to be involuntarily separated from their jobs in early 2020. Like I said, we just got back after 2.5 years to our pre-employment pandemic level. So this didn't just happen in a neutral world where you just had the government inject all of this money into the economy. We don't know what would have happened if there had been a smaller fiscal stimulus, if there hadn't been a second round of fiscal stimulus. We do know that the amount of fiscal stimulus has been tapering off. So it's really it's really hard to say what the net effect on the economy was. I think I can confidently say that there was some inflationary impact of the fiscal stimulus. Does that mean we shouldn't have done it? I don't know. If you were one of the businesses that was looking at shuttering in early 2020, you're probably pretty happy that you got a PPP loan, and your employees are probably pretty happy that they were able to keep their jobs and stay employed. So that's a separate question. I do, obviously there was some inflationary impact, but at that time, the risk in 2020 and into 2021, when we were still experiencing that next wave of the pandemic, the risk was more on the other side of doing too little rather than too much, even if we're paying the consequences now in terms of higher inflation. Again,
Perfect.
My opinion, and not necessarily the Fed's.
Yeah, thank you. There's a couple more that came in. This next question is about hiring challenges. Why is the labor situation so tight? Where are the people?
So where are the people is the big question. So I mean, one thing that's really important to point out is this was an issue prior to the pandemic, and it was especially an issue in Minnesota and in our region. Going into, really almost for like the decade prior to the pandemic, since at least 2011, it was the biggest concern I was hearing from businesses in the region about how hard it was to hire. So this isn't a new problem from that sense. It's a more acute problem, and it's a national level problem now rather than an issue in just say in North Dakota or other areas with low long-term population growth. But I think that's part of the story from a long-term perspective is really a population growth issue. It's a demographic issue. Our population's aging. This is something I actually spent a lot of my time talking about before the pandemic, because this was, again, the most pressing issue that most businesses were facing. And so in some sense, we're back to that now. It's just that right now, the economy has actually been growing really strongly over the last couple of years. So, and just in terms of in GDP terms and output terms, what we're producing, I should have mentioned that in my talk. We just got back to our pre-pandemic peak in employment. We've been back to our pre-pandemic peak in GDP for over 1.5 years. And so we're producing a record amount of output. We've never produced as much as we've been producing now. GDP came down a little bit earlier this year, and that's what's led to some of this recession talk. But overall, the economy is still has been growing over the last couple of years. There's this question about, but there's a lot more time I could spend talking about this. So I'll just say, one of the big stories over the last couple of years is the story of kind of a realignment in workers' preferences, people who lost their jobs, who started, especially women who decided to stay home and care for children rather than return to the labor force, are kind of reevaluating. And right now, because the labor market is so tight, wages have been pretty strong, and that's made it a little more feasible for a lot of people who are on the margin to have a one-earner household. So there's a lot of things going on underlying this labor market tightness. And as I showed you, while we're back to the total number of people that we saw that are employed prior to the pandemic, the ratio of the population is still below where it was. So we know that there are people, at least in percentage terms, who are kind of still sitting on the sidelines right now. Where they are and when they're going to come back is anybody's guess. one thing that we can point to is that we're still seeing really strong job growth, and we're seeing really strong wage growth. So higher wages are bringing people back into the labor market. And that's been the overwhelming story of the last year or so in the labor market data, is that people are coming back into the labor force because it's more rewarding to do so. That's changing their evaluation of that trade-off between, say, staying home and taking care of preschool age children versus working.
Thank you. This next question is kind of a two-part. So what is the impact on cash and unreported income segment of the economy on the unemployment rate and on GDP? Is it measured anywhere besides what the IRS attempts to estimate in terms of unreported economic activity?
Yeah, so I mean, I'll take the second part first, which is just to say, one of the other sources, one of the other ways we have of measuring that is the Federal Reserve actually does a survey of consumer finance and a survey of payment usage, and so we kind of track cash usage. What the net effect is on employment and on GDP, I really can't say. I haven't spent a lot of time looking into it, so apologies. I'm not even going to hazard a guess because I'd probably be wrong, and it would probably be a stupid answer. So that's a horrible way to end my segment, but I hope the rest of it was entertaining, and it's an interesting question and something I want to look into more now that you've asked it.
Yeah, great. Well, thank you, and thank you everyone for all your great questions for Joe.
Yes, thank you, Joe, for the update on the economy and a nice level set on the hot topic of inflation, for sure. Thanks, Joe. Next, we have Shale Lapping joining us. Shale is the president of Ipex, a boutique investment consulting firm. Ipex specializes in working with nonprofits, including community foundations, providing assistance to finance and investment committees in determining portfolio policies and organization investment strategies. Shale has been consulting with CommunityGiving for over 20 years and providing investment analysis and recommendations for the investment pools of the foundation. Shale, share with us your perspective on the market and the investment programs of CommunityGiving. Shale?
Will do. Let me just get the slide up for the full page here. There we go. Great to see everybody. There's an old adage in investing, don't fight the Fed. And I'm going to apply that today and basically say I certainly agree with all of Joe's comments there. Not going to try to take issue with anything. And to take issue with the Fed can sometimes be hazardous to your health from an investment perspective. In terms of Joe's remarks overall, though, what I would say is they are definitely interesting. And number two, there's certainly something we don't want to ignore, because that perspective can be extremely helpful in terms of understanding what has taken place as far as the investment markets. And they can also be very helpful in trying to anticipate what is going to take place as far as the investment markets. However, having said that, that does not necessarily mean that we want to make adjustments in an investment program because of that assessment. That can be a very difficult thing to do. And what I want to do now is try and transition from looking at the economy, per se, to looking at the investment landscape. I'm going to give you some comments about the investment landscape overall, and then segue to the CommunityGiving investment program in particular, in terms of how it is performed and how it is structured. I think that overall, my remarks are going to be a good deal shorter than Joe's, and we should be able to have plenty of time for questions. So I certainly want to, encourage everyone to either ask your questions at the beginning or later on. Feel free. Joe spent a good deal of time in his presentation talking about inflation. And I'm going to begin as a follow-up to that and discuss inflation in relation to the broad investment landscape as to what's taken place historically. We have to recognize every investment environment is somewhat unique, and you can't necessarily extrapolate from what's happened in the past, but the past can provide us with a reasonably good guideline. And the slide is up on the screen. We're looking at data going back to 1947. It's a pretty long time period, all things considered. We're looking at the relationship between inflation and GDP, gross domestic product, the actual returns for stocks, here using the S&P 500 large cap domestic equity as a proxy for the broad market overall, and looking at the average PE ratio, how expensive equities are overall. And what you see here, the key takeaway number one is there certainly it appears to be a pretty strong relationship between the rate of inflation and these other factors here. That across the board, you're going to see higher GDP, higher returns for the S&P 500, and a higher PE ratio when there's lower rates of inflation out there. And you look at the breakdown here, 4 different measurements for inflation, below 1%, 1% to 4%, 4 to 9, and above 9. And the pattern holds in all cases here. The key takeaway, though, from our perspective is you don't necessarily have to have super low inflation for the markets to do pretty well. You know, we can all agree we don't want a high inflationary environment. The type of inflation numbers that we've been seeing, end of 2021 into 22 are certainly high. And that is the reason why the Fed has embarked upon a rather concerted shift in policy now to raise rates and bring inflation under control. Begs the question, what is under control? As Joe mentioned, the Fed's target rate is 2%. That's a heck of a lot lower than it's been as of late. For most of the decade of the 2010s this year, CPI was actually somewhat even below that. But we don't need to have really low inflation for the markets to perform well, for the equity markets to perform well. And again, just looking at this slide here, highlighting the 1 to 4%, recognizing that 4% is double the Fed's target rate of inflation of 2%. In that type of environment, historically, the S&P has returned about 9.8%, which coincidentally is very, very close to the S&P's long-term average. So we're not overly concerned about a moderate rate of inflation, something in the 1 to 4% range. From everything that we're seeing out there, the current rates of inflation, 8, 9%, depending upon which metric you're looking at, are not the rates we're likely to experience over the long term. The Fed seems to be pretty dedicated in taking action to bring the rates down. And the betting going on in the futures market, looking at 2023 and 24, the forecasts there are for much more moderate rates of inflation, which is all kind of a fancy way of saying, in part, that we are not going to try and overreact in an investment program to combat inflation. We view it as something, to use kind of an interesting word, more transitory in nature, sort of more sustained than anyone anticipated last year, but we don't see a return to a 1970s stagflation environment where you're looking at prolonged high rates of inflation and low productivity. And certainly nothing in Joe's presentation would indicate that that type of environment is likely either. But at the end of the day, we simply want to simplify. Inflation is a fact of life. In some environments and higher than others. Typically, it is not particularly high for prolonged periods of time. And inflation in the rate of 1 to 4% is certainly something that's livable and doesn't pose a huge threat to a well-structured investment program that is equity-oriented. Shown here by the fact that you can get pretty much average returns, long-term average returns from the S&P 500 when you're in that kind of environment. Another broad picture issue. And in a few slides or so, we'll start talking about the investment approach, the investment philosophy that's governing the Foundation's investment program. But the point here is we don't want to be engaged in any sort of a timing operation. High inflation, possible recession, bad time for the equity markets. Let's get out. Let's get back into a better environment. Those type of timing decisions are very, very difficult to orchestrate. This particular slide looks at the investment environment, again, is reflected by the S&P 500 from the period of time 2002 to 2021. But I can tell you pretty much any long-term time period you analyze is going to produce results very, very similar to what you're seeing on the screen. Again, what's telling you is if you simply invested on day one in 2002 and were invested at the end of 2021, your return would have been 9.5%. Now, obviously, if you were clairvoyant and could just pick out the few worst days and avoid them, your return would have been higher than that. It would have been a good deal higher than that. But that's a very, very difficult thing to do. And the reality is when you are in the market and then out of the market, back in the market, you run the risk of missing some of the very strong days when the market recovers, because the market can recover fairly quickly in short periods of time and bursts on that. And if you look at this particular slide, what the data is telling you is your 9.5% return, you happen to miss the 10 best days in the market, that return's almost cut in half to 5.3. And you can see the rest of the numbers as well. You missed the top 20 days, top 30, top 40. And that's a big bet. I mean, you want to miss the worst days. You don't want to miss the best days. But very often when you miss some of the worst days, you end up missing some of the best days on that. And the takeaway here is that line at the top of the page. Time in the market is more important than trying to time the market. And our feeling is that's particularly true for an organization such as CommunityGiving that has a long-term time horizon. We're looking at those 20-year periods. We're not overly focused on a month or a quarter. That tends to be a very difficult game to play, as this data, it tends to indicate. Bull markets and bear markets are a fact of life. It would be nice if they weren't, but they are. A couple terms generally used: if a market goes down 10% or so, it's considered a correction. If it goes down 20%, it's considered a bear market. The particular data on this screen is looking at the broad domestic equity market going back to 1966. Been a number of bull markets and bear markets over that time period. What you see, though, is a dramatic difference in the duration of those markets. Bear markets average 14 months, bull markets average 70 months, a multiple higher than the bear market environment. And again, that relates to the previous slide. Trying to time those things is very difficult, given that the vast majority of time is going to be a bull market. Your concern is timing to be out of the bear market and then missing some of the bull market recovery. So from a duration standpoint, there is a significant difference. But there's also a very significant difference in terms of performance. A bear market is not only shorter, but the nature of the downside tends to be much smaller. 37% downside on average in a bear market, over 200% upside in a bull market. So again, putting those two factors together, the bull markets tend to be much longer in terms of duration and tends to generate much higher returns than the losses you would experience in shorter periods of times in bear markets, reinforces the argument for remaining in the market over the long term. None of this is to say that bear markets are fun. They're not, but they are a fact of life, and we need to be sure that the way that we deal with them is appropriate, and we don't deal with them in a manner that will adversely impact our long-term investment process. Let's tie a few points back to Joe's presentation of the Fed. Again, there is a relationship, a general relationship between Fed activity and what happens in the equity markets in a short time. Again, we don't necessarily want to change our investment philosophy because of it, but we want to understand what is going on. When the Fed raises rates at consecutive meetings, and when the Fed raises rates aggressively, it tends to have a negative impact on the equity markets. What have we seen? We have seen 4 consecutive raises by the Fed at their last 4 open market committee meetings. And I would say a virtual certainty, which Joe can't say, that there will be another increase at the next meeting on September 21st. Last 4 increases were 25 basis points, 50 basis points, and then 2 75 basis point increases. 75 basis point increases are huge by historical standards. Those don't typically happen, but again, we're coming off of extremely low rates and an atypical environment based upon the Fed's response to the pandemic. So trying to draw all these historical parallels can be a bit trying. But right now, the odds are, last I've seen, about 50-50 as to whether the next Fed rate increase will be either 50 basis points or 75 basis points. Basically, no one is saying it's going to be lower than basis points, lower than 50 basis points. So that is the environment that we are in. And when the Fed acts aggressively, market volatility increases. That's not a surprise. We've seen that. We will probably continue to see a lot of that going forward. The other reality is, and Joe mentioned, we've technically seen GDP contraction for the first and second quarters of this year. We continue to have a pretty good economic environment as far as the employment picture and corporate hirings, certainly right now. And the prospect for recession is somewhat uncertain. But the reality is, when you go through Fed rate increase cycles, more often than not, a good deal more often than not, you do end up in a recession. What the Fed ideally wants to try to orchestrate is that soft landing, where they can bring inflation down to their appropriate target levels without pushing the economy into a recession. That's a nice goal, but the reality is, in the majority of cases, that doesn't happen. We do end up in some sort of recession. But again, recessions are a fact of life. We go through them, we end up stronger, we end up with solid periods of growth afterwards. So again, whether we definitely end up with one is debatable. The bigger question is, how long may it be? How severe may it be? We don't know. That's what we all have to continue to monitor going forward. So those are my comments regarding the broad environment as far as looking at what's happening in markets. But let's kind of talk about specifically what's taken place in the investment markets this year. And by any standard, it was ugly for the first half. Many of us have gotten kind of spoiled the last few years with very strong returns, exceptionally strong returns from equities, particularly domestic equities on that. And fixed income doing pretty well for the most part also, because fixed income did well as rates went down. But the numbers for the first half of the year were not something we were used to seeing. All negatives. I spared you putting these numbers in red, and I think we've all seen too much red as of late. But these are all negative losses, significant losses for the first 6 months of 2022. I highlighted the fixed income number here because we tend to accept at some level that we're going to get big losses from time to time in equities. Large cap stocks, small cap stocks, the international markets, be they developed or emerging. We know that will happen from time to time, but most of us don't expect to see large losses of this nature on the fixed income side. But that is the direct result of first the expectation and then the reality of the Fed raising rates and the markets responding to that. That is simply how the fixed income markets work. When interest rates go up, the return for fixed income goes down. And those are the numbers that we had to contend with for the first half of this year. I will tease you with a bit of an update on these numbers at the end of the presentation, but for the first official 2 quarters of this year, these are the numbers that we had to address. With that now as a backdrop, I'm going to talk specifically about the Community Giving Investment Program. And what's important to recognize here is the main funds we're talking about are endowment funds, which is a fancy way of saying they have a long-term perspective. In structuring these investment programs and working with the investment committees here, our goal is to make sure that these programs are properly designed to meet their objectives over market cycles, over many years, over decades, recognizing again that they will experience losses in down market environments, which are inevitable. But we're not going to try to react significantly to those down market environments and to try to time them. And the technical way of saying that is our approach is overwhelmingly strategic for the investment program rather than tactical. We're not going to try to exploit all that data that Joe presented. That's a very, very difficult thing to do. If we can focus on the main trends in the market and be properly positioned for the long term, generally speaking, that should serve us very, very well. The foundation maintains 3 pools. Money that's aggregated from its donors and then pooled based upon donor selection. There's also some money that's maintained outside of these pools, but the vast majority is in these pools. And I want to focus on those as far as both their investment results, their allocations, and why those two factors relate to each other in accounting for some of those differences in performance. As of June 30th of this year, which is where most of this data is coming from, these were the market values of these three pools. The strategic pool, close to $115 million. Obviously, the bulk of the assets at 75%. But these other two pools, MC stands for moderately conservative. And the SRI and II is kind of a mouthful, socially responsible investing and impact investing pool. So more of a social focus there. Okay. Moderately conservative and socially responsible are substantially smaller than the strategic pool, but they are certainly good-sized and viable pools in their own right. And the investment committee focuses on all three of these pools as far as their targets, their allocation, their vehicles. And our firm is regularly monitoring those three pools and reporting to the committee. Let's talk about the asset allocation, the target asset allocation of those three pools. It's important that that's a target from a strategic standpoint. They can be adjusted periodically, but again, periodically, not regularly. We're not trying to adjust the targets to exploit market conditions. We're trying to determine the targets in order that they're appropriate based upon the objectives and the risk level of the portfolio. Strategic portfolio, where the bulk of the assets are. 20% in fixed income, and that is a diversified portfolio, so it's not all simply investment grade. It's into a number of other segments of the fixed income market as well. The dominant portion is what I refer to as traditional equity, which is the sum of domestic and international, 65%, roughly 2/3 of the portfolio, and then 15% of the portfolio in a mix of strategies and vehicles under the broad alternative heading designed to provide increased diversification and return patterns that are distinct from both the fixed income and the equity sides of the portfolio. Moderately conservative. Key figure here is 60% fixed income, 3 times the fixed income level of the strategic portfolio. Balance in traditional equity, split between domestic and international, no alternative allocation. Last portfolio, the socially responsible investing portfolio, basically mirrors, for the most part, the allocation of the strategic portfolio. A little bit different because a lower allocation to alternative investments at this time, with that money then allocated between domestic and international. But the overall risk profile for the socially responsible portfolio, I would say, is very, very similar to that of the strategic portfolio, with the SRI, or these days, if you want to say ESG orientation, in order to differentiate that as far as its actual implementation. So that is the structure of the three pools, that we're working with. How have they performed? Rough year so far in 2022. Couple of points here. Not surprisingly, you see a reasonably similar level of returns or amount of losses for the strategic portfolio and the socially responsible portfolio. You see what may appear to be at first glance a surprisingly high level of loss for the moderately conservative portfolio. When your strategic portfolio was losing 15.7 and your moderately conservative portfolio was losing about 14.6, you wonder what's moderately conservative about it. And we'll talk about that momentarily. Key point, though, is looking at returns over longer time periods, which is something that we stress with the committee and we stress to all of our clients. And that really is the hallmark of looking at the importance of the strategic allocation. Looking at returns over 3 years, 5 years, and 10 years here. Look at 5 years, for example, and over 10 years, you see a significant difference between the level of return for the strategic portfolio and the moderately conservative portfolio, which is what you would expect. Over time, in most environments, an investment portfolio with a much higher level of fixed income is going to generate a lower return. Now, for a good portion of this environment, fixed income did phenomenally well. when rates were coming down. The challenges in fixed income will probably continue to be more significant going forward. Strategic portfolio and SRI portfolio, different mix of vehicles, even though the allocations are substantially similar. So you do see some differences in results. We would not consider those results to be particularly dramatic in most cases. We'd expect them to probably be fairly similar over the longer term. But let's unpack a little bit exactly why these disparities in performance have taken place this year among these portfolios. I mentioned before the alternative component in the strategic pool, which is intentionally designed to provide diversification and make sure a portion of that pool does not move in sync with the traditional markets, both fixed income and domestic equity. So what's happened so far this year? For the first 6 months, that portion of the portfolio, 15%, actually generated a gain of roughly half a point, 47 basis points. It was positive. Oh, sorry, I hit the wrong. Let me go back. Give me 1 second here. There we go. Okay. Okay. Focusing on the moderately conservative pool, 0 allocation to the alternative component. So there's nothing there to really buttress this portfolio when the markets were going down. 60% allocation to the fixed income markets. Typically, you assume that is going to be relatively conservative. You may get a lot of gyrations and volatility in the equity markets, but your fixed income component should help to stabilize the portfolio. What happened this year? The fixed income component for the moderately conservative account lost 10.85%. Troubling, but not surprising. If you remember a few slides before, we looked at the return for the broad fixed income benchmark, down 10.93%. So our fixed income component here performed in line with the fixed income market. Unfortunately, fixed income was not a particularly good diversifier for equities. The losses were somewhat lower, but nowhere near what we would expect under typical circumstances. So given the large loss on the major fixed income component and the absence of an alternative portion of the portfolio, the large loss for the first half of 2022 for the moderately conservative pool becomes somewhat more understandable. Let's look at what was going on in the SRI ESG portfolio. Here we can look at a direct comparison of vehicles. In the moderately conservative portfolio, the domestic equity allocation consists of the Vanguard Total Stock Market Index Fund. That fund for the first half of the year was down 21.39%, essentially tracking the market within a few basis points. Now, for the SRI portfolio, in the case of domestic equity, we also have a broad market Vanguard domestic equity index fund. But because of the nature of this portfolio, this fund has an ESG orientation. So its sector allocation, some aspects of its security selection are different. Over the long term, those differences tend to average out. Over the short term, however, they can be fairly significant. What we saw for the first half of the year is that virtually every sector in the broad economy, as far as looking at the stock market concern, incurred losses. And most of those incurred fairly significant losses. There was one exception, though, and that exception was the energy sector. Energy sector performed extremely well due primarily to the increase in the price of oil. However, when you're looking at an ESG-oriented portfolio, most, if not all, of the energy stocks are screened out. So for 2022, for the first half of the year, there was a cost associated with ESG orientation, and that's why you saw the SRI portfolio underperform the strategic portfolio, and again, the equity portion of the moderately conservative portfolio as well. Exact same explanation when looking at the international component. Broad-based index funds here, but different focus specifically because your ESG fund is limited as far as its sector allocation and will have some differences that are meaningful in relation to the broad market environment. Again, those differences don't concern us over time. They will probably tend to average out over a sufficiently long time period, but in an environment where you have huge disparities between subsectors of the economy and others, you're going to see these disparities in performance. Not a concern, a reality. Going back and touching briefly on the structure of these portfolios, the Foundation's Investment Committee has made a decision for a number of years to maintain a meaningful level of indexed exposure. They like the low costs associated with indexing. They don't want to be involved in timing decisions. And they feel that in some segments of the market, having an index exposure is likely to generate better returns than the vast majority of actively managed options. And you can look at these breakdowns here by the major asset classes. Probably the smallest number, or clearly the smallest percentage of indexing is in the case of fixed income, where we just don't see an awful lot of that. In the case of domestic equity, all of those components are indexed for the moderately conservative portfolio and the socially responsible portfolio. Roughly 3/4 or so are indexed for domestic equity in the case of the strategic portfolio. And you can see a breakdown somewhat similar to that in the case of international equity as well. So very active strategies in the case of fixed income, also very active strategies in the case of the alternative component for both the strategic and the SRI portfolios, more index orientation on the traditional equity side. Lastly, the update that I teased you with a little bit at the beginning of the presentation. This is the performance for the broad market indices through just the other day, August 23rd. What you've seen here in comparison to the June 30th numbers are a very slight recovery in the case of fixed income, about 0.5 point better. But while we're still looking at meaningful losses in the case of equities, both domestic and international, the losses on the domestic equity side are a good deal smaller now than they were at the end of June. The large cap market and the small cap market have both recovered a substantial percentage of the losses. Recovery for international has been more muted there. And again, this is through August 23rd. How things play out through the remainder of the quarter, the remainder of the year are anyone's guesses, but at least those large losses we were looking at have moderated somewhat. And I would expect at this point, when we work through the numbers for the Foundation's portfolios, we are going to see a corresponding moderation in the losses we've experienced so far this year. So again, in all likelihood, still 2022 will be a negative year, but hopefully we continue to bounce back along with the broad market, and those losses will be somewhat less. That's kind of a quick recap of what's taken place. Happy to take questions now regarding any element of these slides here, or any of the questions you'd like to ask regarding the investment program.
Thank you, Shale. Do we have any questions for Shale? You can either chat, send him the chat to me, or ask him live yourself if you'd like. But kind of as we might be waiting, we have a couple questions from before. But the first one is, should we be changing the investment allocation of the Foundation's pools?
That is a good question, and it's the key question. As I mentioned, the allocation in most situations, particularly in an index situation, is going to be by far the dominant factor impacting the return and the risk over time. The target allocations are not etched in stone. It's something we do review with the committee on a regular basis. The key point I would say, we don't want to be making a change in the allocation based upon short-term economic data, based upon what we think may happen over the next 3, 6, 9, 12 months. We want to make a change, and we feel fundamentally we want to adopt a more aggressive posture in some areas. We need to make adjustments because of our objectives with a longer-term time horizon. No magic figure, maybe 3, 5, 7 years. Yeah, I would say right now we are generally comfortable with the target allocation, but that doesn't preclude changes down the line. So it's something we're going to review. I would say I certainly don't want to see us increase our fixed income allocation. We look at survey data from other foundations as well. And while there's a lot of limitations with that survey data, the main takeaways is as you look at bigger foundations, not just community foundations, but private foundations as well, as you look at foundations across the board, as the asset size of the foundation increases, the target fixed income allocation goes down and the target alternative allocation goes up. Very strong relationship there. So if anything, we might move in that direction, down the line, but it's something the committee typically considers in a very thoughtful manner. They don't jump into those types of changes.
All right, great, thank you. I'm not sure if you covered this, so let me know if you did, but what is the reason for the negative results in the bond market?
Our good friends of the Fed raising rates. That's simply, it's math, it's reality. When the Fed raises rates, fixed income returns go down. Fed has raised rates significantly on that, and we have seen, a real rough market for fixed income. Again, if we go back to before this rate cycle started, now the Fed funds rate was a range of 0 to 25%. Our friends in Europe have gone negative sometimes in that. The Fed didn't do that, but outside of going negative, you can't go much lower. So we knew they only had to go up. It was a question of how fast and how much. And they waited until this year to do it. We talked about the delay that maybe they should have acted last year, but for various reasons they didn't. And they started raising then pretty aggressively. They telegraphed they were going to do it, and the markets responded, and I said, both in anticipation of those rates, in reaction to those rates. And that's why you've seen a very difficult year in the fixed income market, but there's no surprise. There's no way you could avoid that with the action the Fed had to take.
Thank you. I do have one more question for Joe, if he's still on, but this is about supply chain. Could you just say a few words about the cause of the supply chain issue? Or just say a little more information about that?
I'll try to say a few words, but there's a lot more. There's a lot that I could say. What I like to say is that what's been going on with the supply chain fundamentally is a traffic jam. It's that there's been a lot of stories that have been printed over the last couple of years about capacity at deep water ports, about rail, about the labor market for truck drivers. Every node along the supply chain has some sort of choke point on it. But what's going on fundamentally, and I would go back to that picture that I showed earlier of the change in goods consumption. And I was talking about how largely as a consequence of the pandemic and people not being able to spend their money on services, among other things, you can think about yourself. If anybody out here has been working from home, you maybe at the beginning of that period, you were looking around and saw your deck and thought, oh, boy, it's looking kind of ratty. Maybe I could redo my deck or my kitchen, right? So people started investing a lot in their houses first. So actually, the construction materials were one of the first things we really saw take off in that early phase of recovery from the pandemic. So ultimately, what's going on is that people started buying a lot more goods. And that's been gumming up the supply chain, because a lot of our goods or the inputs to our manufactured goods come from overseas. Semiconductors are a great example of that. There are a lot of some people who are more specialized in this field of logistics and industrial organization have written I find some very compelling arguments about, if you will, kind of the over-optimization of the supply chain over the last 20 years or so. There's been the logistics revolution and just-in-time manufacturing and all those kinds of developments, which have made our supply chain hyper-efficient but not necessarily robust to big shocks, not necessarily, and maybe it's that efficiency has come at the cost of being a little more fragile as well. So there's some of that going on, but I think fundamentally, asking what's been going on with the supply chain is like asking what caused a traffic jam. Is it that there was an accident on the interstate? So was there construction? All of those things can make the problem worse or exacerbate it in certain places. But ultimately what it is everyone wants to use the freeway at the same time, and that leads to congestion. So that I find to be the ultimate story of what's going on. Now, a lot of these choke points and other things are infrastructure issues, and there's been some movement at the federal level to try and address those things, but those are long-term fixes, and I wouldn't expect any of them to really have a big impact on either the state of supply chain right now, or certainly not on inflation at this point.
Thank you. We have one more question. Maybe if both of you want to answer it a bit, or maybe pick it's might be better for Joe, but kind of going back to the previous question, besides the Fed rates, what conditions will cause the bond markets to recover?
I'm waiting for Shale to take that one.
Let's take it first.
I think the key overall is inflation. We need to see inflation come under control. We saw numbers come down. The July number, 1 month doesn't make a trend. We don't have to get back to 2 or 3%. That may take a while, but we need to see some clear evidence out there that inflation is moving in the right direction. I think once we have that evidence, you're going to see a much higher level in the bond market. Exactly what level of evidence you need remains to be seen, but we don't have it yet, and that's some of the concern.
And I may be talking out of turn here or speaking above my pay grade, but I think a lot depends on it is going to depend on what happens in other countries as well. Right now we have a really, really strong dollar right now, because in spite of everything going on in spite of everything you might point to in the United States, people want to invest in the United States right now, and that's going to affect returns here as well. Yeah, I'll leave it at that.
Okay. Are there any other questions? We can stay on for a few more minutes if anybody has any questions, but those have been great questions so far. I really appreciate you both. I have learned a lot, so thank you.
Yeah, thank you. I really appreciate the opportunity to speak, and really appreciate the opportunity to listen to what Shale had to say as a very informative, fascinating presentation.
Great. Yeah, thank you both. Now, I want to welcome back Steve, our president and CEO, if he wants to say a few last words.
Just want to say thank you so much, AJ and Shale, Joe. No very specific predictions, which we didn't expect, but great insights that will help us as we all move forward. So really appreciate the great work you do in Joe, in your case, and helping us understand the overall economy and what's going on. And Shale, of course, we greatly appreciate your insights as we invest our donors' dollars and try to be good stewards of those dollars. So thank you both very much. We appreciate you being with us. For those of you who are online, we will have a recording of this available. So if you enjoyed it or want to pass it on, that will be available following this webinar. We want to thank all of you for attending and for your insights. We do plan to have future webinars, and if you have some ideas or thoughts that you would like us to cover, please send us an email or continue to put it in the chat. And most importantly, we want you to feel free always to reach out to your local community foundation and the local executive director in your area. Their contacts are and contact information are on the screen there. We have a fabulous team that is standing by always to help and assist you. And we do welcome your feedback and comments, and you can reach us at info@communitygiving.org. We do have a number of resources available for professional advisors and others at communitygiving.org as well. And we also have a number of tools and handouts and information on planned giving and different ways people can give back to their local communities, also at plannedgiving.communitygiving.org. So watch your email for our future webinar series coming up in the fall and winter months. And again, thank you so much for being a part of it. Joe, Shale, again, thank you, and hope you all have a fantastic rest of the day. Thanks for joining us. Bye-bye.